Interesting note from Chris Wood this particular week in his weekly newsletter, Greed and Fear. So Chris Wood of Jefferies has continued to maintain his stance of advocating the back to normal cyclical trade. What he believes is that the vaccine rollout story will continue to prevail over the ongoing continuing rise as far as the number of COVID cases are concerned. He believes that the cyclical view, however, is now a bit of a consensus, and the other worry according to him is that American stocks at this point of time are insanely expensive, and these are some of the worrisome factors. So what he has been advocating, that the cyclical view is something that you need to keep an eye out for, now has become a consensus trade, and that is actually worrying him. He's also speaking quite a bit about inflation. He speaks about how the Baltic Dry Index has actually gone ahead and surged by 63% since early December. Now, the other bubble that he speaks about and what actually worries him is the extreme divergence between US corporate profits and the S&P 500 index. In fact, he says that the divergence is now more dramatic than it was at the time of the Nasdaq Internet bubble. Chris Wood in this particular newsletter has devoted quite a bit of time and space to the Indian stock market. Now what he is saying is that greed and fear continues to like the Indian stock market this year, despite the fact that last year you actually saw some record inflows as far as FII investments in India was concerned. He believes that one of the key reasons that why he believes India could outperform in this year is the scale of the cyclical recovery in the coming fiscal year. He also believes that the recent inflation data has given the Reserve Bank of India more room as far as maneuvering interest rates is concerned. Now, the other thing that he's surprised by, and positively, is that the data on the pandemic continues to be quite good. The recovery rates are quite good, and this, he believes, is another reason why Indian equities must be owned. Now, he speaks in depth about one particular sector that has been down in the dumps for quite some time. He says that there is a clear evidence of cyclical recovery as far as the residential property market is concerned. He says that the sales volume in the Indian housing market peaked out back in 2013. He says that volumes were still 1/3 below their peak in 2019 before COVID hit. Now, what he is saying is that listed property developers last quarter actually showed clear evidence of recovery, and he says that the new housing cycle, once it starts, will continue to last and is expected to last for at least 5 years once it starts and once it gets going. He also states that given so many regulatory changes in the real estate space in the last couple of years, there has been a complete shakeout as far as weaker developers are concerned, and he believes that the large listed players are the ones that stand to gain the most, and which is why he continues to believe in their stories and continues to believe in owning them, as he believes they will be the biggest beneficiaries of the upturn, according to him, in the residential real estate market.